So thanks, Eloise. What I'm going to go through today is just a bit of an overview of some of the kind of borrowing and expenditure trends we're seeing here at Equifax, and really kind of looking at how credit and transaction data looks in a kind of changing mortgage market. So as we know, we've all sort of been through a cost of living crisis the last few years. And if we think back to sort of the end of 2023, what we were seeing back then was kind of like a higher cost of living. So everybody was kind of facing higher prices. Inflation was starting to level off at that stage. Prices were still rising faster than wages. Also, we'd seen kind of rises in interest rates, and we're still living with that today. So rates had hit a kind of historical high following some market turmoil. And the result of that was mortgage shock. So mortgage borrowers were coming off long-term, low-rate fixed mortgages and trackers, and they were finding that the market was offering products that were vastly more expensive than the ones they were used to. And at the same time that all of this stuff is happening, then we have kind of utility prices rising, partly as a result of the war in Ukraine and for other market reasons as well. So consumers were being kind of hammered on multiple fronts. So if we take a look at what's been happening in the mortgage market since that time, and really it's it's a story of slow recovery. So in 2023, we'd seen a huge drop off in the kind of number of mortgage originations. And then throughout 2024, we saw a slow recovery. So we saw about 4.1% of mortgages coming back following that big dip in 2023. So quite a substantial drop in demand for mortgages at that point. And as we know, because of those rate changes, repayments kind of remain high. And so overall, at the moment, average mortgage repayments are about £221 higher than they were back in 2022. And for new mortgage customers, repayments on average are 58% higher than when Liz trusted her famous budget. So the way that consumers have kind of handled this is to really kind of change some of their behaviours. And one of those behaviours is in mortgage terms. Consumers are kind of typically taking mortgages over a longer period of time. So today, 30% of new mortgages have terms of over 30 years. And consequently, we're seeing a rise of lending into retirement, people who are kind of borrowing beyond the traditional kind of retirement ages of sort of 67 years old. Now, that's not to say that all consumers will borrow into retirement, but it does mean that they're sort of taking a financial commitment over a longer period as a means of kind of coping with the higher cost that mortgages now represent. Looking at mortgage arrears, so missed payments, what we saw again as a result of those kind of rate rises is that we saw quite a big increase in the kind of number of people missing payments on a mortgage in the first few months of 2023 and into 2024. The good news is that arrears kind of behaviour peaked during 2024 and is now falling. But what was driving most of that arrears was actually older borrowers, so people 56 years and above. And those people were kind of, I guess, a bit less able to kind of mitigate the mortgage increases by borrowing for a longer period of time. So it was very often those people who were unable to find a new product to move to. So if we look outside of the mortgage world and into kind of broader unsecured lending, we see a kind of changing picture there as well. And so if you think back to the pandemic, people were really kind of saving a lot of money. They were paying off credit cards. And what's happened in the last couple of years is that credit card growth has continued to come back. It's come back fairly strongly. And in 2024, we saw 18% growth in new card openings and a 17% increase in the number of credit limit increases as well. So big sort of surge in demand really for credit cards. What that looks like is total credit card debt now exceeding 70 billion. That's sort of historically quite a big figure, but it's not sort of troublesome economically. We see that credit card debt's about 4.5% higher than it was during the pandemic. If you recall, I said that during the pandemic we sort of saw big sort of declines in credit card debt as well. So it's up further. It's up compared to where it was, but it's not sort of significantly or worryingly high. So people are kind of using credit cards again. The other thing they're doing more and more is using buy now, pay later. Now, this is particularly a form of credit that's a bit more difficult to get on a credit report. These products are shared, but they're not sort of necessarily shared in their entirety by the companies that run these products. But nevertheless, for buy now, pay later, we see kind of a rising popularity of these. So around about 36% of consumers have used one of these products in the last couple of years. About 25% of people have transactions in any given month. And typically what they're spending on it is around about £66 a month, a little bit up from where it was the year before last. But yeah, that's the kind of typically what we're seeing on buy now, pay later. So with these kind of, I guess, the sort of cost of living crisis and also the changes in kind of mortgage repayment costs and so on, it's worth looking at how consumers navigated that change. And the way we do this is by looking at real customer spend. And in our case, we can look at this through transactional data from open banking. So what we've done in the next couple of slides is taking a look at what people have spent on grocery shopping over a 2-year period. Again, this is something that wouldn't appear in a credit report, but it does appear through open banking. And what we've done is compared what people spend on average with ONS, or Office for National Statistics estimates, and then adjusted those for inflation. But this is an approach which is widely used by lenders to kind of estimate what people need to spend. And then what we've done is compared that for different income groups as well. And what we see is that for people in the kind of lowest income groups, so in this case, the second lowest income decile, second lowest 10% group of consumers in terms of income, they were kind of immediately impacted by food inflation. So when we saw, food inflation in the shops hitting 10, 11, 12%, these people, their expenditure went up in line with ONS, or in line with inflation. And so ONS did a really good job of predicting what would happen to spend for that group of people. But if you look at middle earners, what they did, the dotted line here shows the kind of rise in inflation for ONS food expenditure. What these people were doing was kind of constraining what they spent. They were mitigating the effects of inflation in a way that lower earners were unable to do. So in this case, ONS fails to kind of pick up on that behavioural change. And what we can see from transaction data is that consumers were kind of trading down their supermarket. Okay, so they're buying cheaper products, they were buying own brands a bit more, and our share of wallet analysis allows us to see who those kind of winners and losers are. So looking at primary supermarkets, so who do you spend with most frequently? During this period, it was Aldi and Lidl, unsurprisingly, who kind of gained the most market share of primary supermarket. Sainsbury's and Asda were both down by about 0.6, 1.2% overall. And then the slight surprise for me is that Waitrose went down, which you might have expected. M&S food went up. So M&S was kind of a sort of net beneficiary during the cost of living crisis. I think because they had a focus on some of the kind of core staple food products as well during that time. So it's kind of gives you a kind of interesting angle on how the use of transactional data can tell a different story from what some of the assumptions might otherwise be. So that brings us on to how lenders assess affordability and how that's changing as well. So if we think about some of the typical approaches that lenders take when they're assessing income and affordability and expenditure, they tend to look at 4 things. So the first of them is bureau data. So they'll look at a credit reference agency and look for credit commitments, for rent, for mortgage payments, utility payments, and so on. Then they'll look to income to verify income. And to do that, they typically use current account turnover, which is information supplied by current account providers, and increasingly payroll data, HMRC data as well. And then there's kind of what I've termed self-declared information. So this is what customers tell you about what they spend, or what they share with you through something like open banking or the uploading of bank statements. So those are the kind of 3 sort of sources of information that lenders will use. And any gaps they tend to plug with these kind of income assessments or assumptions from sources like Office for National Statistics. Now, as we've seen, some of the limitations of those model views can be that inflation is experienced differently by different customers, by different consumer groups, but also in different categories. So the expenditure that you see or the inflation you see on groceries is sometimes experienced differently from what you would see on gas bills and so on. So consumers react differently, and also the real world experience of inflation is different for different consumer groups as well. So what we're seeing is that lenders are taking a much more granular approach to assessing expenditure, and in the way that they assess, that they make assessments of kind of assumptions of spend, they're also starting to look at a lot more granular detail at what the transaction data can tell them. So to give you a sense of what open banking can do for a lender, it really kind of gives you a lot more information than a traditional credit score or traditional credit file would do. So using the transactional data, we can work out where does somebody work. So we know that someone's employed by a local estate agent, for example, who's been there for 12 months, because we can see recurring transactions from a particular salary. We can see what the salary is, and we know it's salary because it says so in the transactions. And we can identify things that, again, are not visible to the credit reports, things like, are you paying your council tax? Are you up to date on insurance costs? And so on. As well as in there's some additional behavioural things like, do you gamble, do you withdraw, lots of cash, all these things that might be kind of viewed differently by different lenders. So it gives a really kind of rich, granular view. And increasingly, lenders are kind of looking at this data and thinking of ways that they can help customers get over the line and help them sort of successfully take out that mortgage application. I mentioned another source as well. Increasingly, we're seeing our clients use payroll data and HMRC data as well. So we have a couple of sources for this, which gives us roughly 50% coverage of payroll and 100% coverage of HMRC, assuming those customers can access their gateway. So a couple of extra sources that lenders are starting to use there. So as we've seen, I think that the way that lenders are using data is starting to change. And so it means that when customers are thinking about how do I sort of get myself ready for that mortgage, there's a few sort of hints and tips that we can share with them. So a few things that I've sort of thought up here. So the first bit of advice I'd have for mortgage applicants will be about keeping credit repayments up to date, but also registered to your current address. And make sure you're on the electoral roll because that's a kind of key source of identity information. I think also, using credit's usually a good thing. So if you've got a credit card, if you've got a personal loan or something, it's good to have those products, but you should always stay within your limits. Don't go mad with what you borrow, and keep your balance reasonably low. I think also a good practice is to monitor your credit report and score. There's lots of different services you can get these from. You can get them from Equifax, but there's other providers out there where you can go and see exactly what data is held and what your credit score looks like. And if anything's wrong on there, then contact your lenders and get those details collected. And finally, for organisations that do request bank account information from you, whether that's through statements or through open banking, make sure you're sharing relevant accounts. So make sure it covers all your income, your main bills, and the majority of day-to-day spending. I think in terms of negative spending patterns, it's difficult to sometimes break those habits. But if you can avoid doing risky things like too much overdraft usage, too many declined card payments, and also trying to avoid high-value gambling, those are kind of all good practice bits of advice that I think will help people with their application. So that's it from me. Back to you, Eloise.